I had a feeling that I was going to be making this video today, and as much as I don't really want to talk about all the banking crisis stuff, it's pretty much unavoidable. We have to talk about it because it affects everything else in the broader economy, including the housing market, and we just need to talk about it so that way people know what's going on. In fact, we just had the second largest bank failure in American history, First Republic Bank. Prior to now, Silicon Valley Bank held that title, but not anymore. Now it's First Republic Bank. And this is what, the fifth bank failure that we've seen in the past month and a half now. And we're talking big banks that hold a lot of money, guys. And we kind of covered this a little bit in Sunday's video, but we're going to talk about it more in detail now that we know what's going on. We're doing this video from beautiful Miami Beach Marina. It is a stunningly gorgeous day out here today. It's like 80 degrees, pretty low humidity actually. It's beautiful. But anyhow, what ended up happening? Well, we knew that the government was not going to bail out First Republic in this case. We knew that wasn't going to happen. They said that they weren't going to do it, and everybody was afraid that the stock market was going to crash come Monday morning if they didn't step in and do something. Well, they had a new savior in this case, which was JP Morgan. JP Morgan stepped in at the last moment on Monday. So JP Morgan stepped in and they agreed to buy all $92 billion in both insured and uninsured deposits from First Republic. And they also agreed to buy most of the bank's assets, which include about $173 billion in loans and $30 billion in securities. Turns out the FDIC is going to share in the losses on First Republic's loans starting on Monday, which by the time you guys see this is already Tuesday. But on Monday, all of First Republic's 84 branches are going to resume normal business hours and now be operating under JP Morgan, and all of the bank customers are going to have access to their deposits, which is really good news for people that had money in this bank, because it's really not fair to the depositors, especially if you're under the FDIC limit, to be affected by all of this. I read some stories about people taking money out of that bank and putting it in a different bank even though they had less than $250K in deposits, just to not have to deal with the potential problems that come with trying to get your money back when there's a bank failure like this. And I don't blame anyone for doing that. I mean, that's kind of the smart thing to do if you ask me. If you know it's coming and you are one of the lucky ones to get a heads up on the bank failure, might as well pull your money out while you can rather than wait for the FDIC to cut you a check, you know? But in this case, all the depositors are going to get lucky, and they're not going to have to worry about that because they just all of a sudden got assumed by JP Morgan. So unlike Silicon Valley and Signature banks, this is not a bailout, but rather a takeover from a larger bank. At this rate, if we keep seeing bank failures like this, we're going to be down to only a handful of banks in the country. And like we talked about before, this puts an extra risk and a massive amount of strain on these larger banks, because it does put them in the position where they're like too big to fail, right? They cannot go under, because if they do, then the whole system collapses because they just hold too many loans, too many assets, too many people's deposits, and that's what led to all of the bank bailouts back in 2008. And speaking of which, JP Morgan was on the list of banks that received bailout money back during the great financial crisis. So one interesting way to look at all of this is that you actually bailed out First Republic Bank about 15 years ago whenever the US government bailed out JP Morgan, because if it wasn't for those bailouts back then, there would be no JP Morgan today to absorb this First Republic failure. So at the end of the day, it's still all of our tax money that was used back in the day for the bailouts to eventually allow something like this to even happen. And like I keep telling everybody here on the channel, this is not going to be the end of this. We're likely still going to see more banks collapse over the year because there are a lot of problems with the banking system right now. In fact, banks have more than $620 billion in unrealized losses at the end of 2022, which is mostly because of these rapidly rising interest rates that the Fed has been pushing through. So all of these banks are having the same problems. It's not like this is something unique to Silicon Valley or to Signature Bank or to First Republic. This is something that could happen to any bank potentially. And what causes it to happen is when a lot of people start pulling all of their money out all at once, which is exactly what started happening here with First Republic. So then you might be wondering, what is our government, what is Congress trying to do about all of this? Because this is obviously a big problem that we're facing right now, and no doubt that it is. And there is a bill that's trying to get passed right now in Congress that's called the Failed Bank Executives Clawback. Now listen to this. This would be a situation where in the event of a bank failure, this legislation would empower regulators to claw back compensation received by bank executives in the 5-year period preceding the failure. So you got all of these hotshots at the bank that like to pat themselves on the back and give themselves multi-million-dollar bonuses every year. Well, all of those bonuses can now be taken back retroactively if something like this passes, going back 5 years if the bank fails, which is a good thing because it puts more responsibility on these bankers that are in charge of so many people's deposits and, you know, all of your money, guys. Now, this is still a bill. We don't know if it's going to pass yet, but at least they're on the right track trying to do something about this. And also part of this new bill could be a change where they're going to require executives' compensation to prioritize long-term performance with bank assets from now on, rather than these short, quick wins that they've been going after for the past 15 years. And it would also require a bunch of these bank executives to hold a substantial portion of their stock and options in the bank until they retire, instead of taking the money and running whenever they feel like it and heading for the exits. So this would definitely put more responsibility on these big shot bankers and put more pressure on them to make sure that this doesn't happen anymore. But the biggest problem, as we can see from this law that they're trying to pass, is that once again, bad behavior has been rewarded time and time again for these banks, and that's what's made them take so many risks and, you know, put so many people's deposits on the line, and it's leading to these bank failures now that the interest rates have been going up. Now, one way that we know that this banking crisis is far from over yet and how this is going to bleed into real estate and the rest of the economy is because of the commercial banking crisis, because the office spaces in particular are in big trouble right now. In fact, all the banks have been gearing up and have been requiring more deposits on hand, anticipating more defaults in the commercial sector. So this is something that they're already expecting. They know it's going to happen, and it already is happening in many cases. How does this affect everything else? Well, this is how, guys. It puts a damper on the bank's earnings, so their profits go down, which likely means that their share prices go down. It also means that they cut back on lending because they need to keep more of that money on hand, anticipating more defaults. And it means more places going out of business because that's part of the credit crunch that we've talked about. It means businesses not being able to meet payroll in some cases. It means businesses not being able to get the loans they need to expand or move forward. And you know, businesses that have cash flow problems might not be getting the loans that they need, and so they might need to lay people off and cut back on their spending. And it's just like this trickle-down effect that spreads across the entire economy. And combine that with all these closing office buildings because no one's in them, you know, what's going to happen to all this commercial real estate? You know, who's really going to take this loss in the end? And this is how much all these banks are gearing up for these defaults. The four largest banks, Wells Fargo, JP Morgan Chase, Bank of America, and Citibank, all of them combined now have $62.9 billion of loss provision, according to their first quarter financial statements, which means that that's how much they're expecting in defaults. But it could be much more than that. That's just how much cash they have on hand in order to hopefully compensate for the amount of defaults that might come. That's a $12.6 billion increase of the reserves that these banks held just 6 months ago. So you can see that they are continuing to increase their reserves, anticipating these corporate defaults. Wells Fargo, for example, has seen the amount of bad office loans that they're holding go up 4x over the past few months. And now you got the big shots over at Citibank and JP Morgan coming out and saying this is the early stages of this real estate downturn, guys, and they're going to start seeing some meaningful losses in the near future when all these people that owe money on these office buildings can no longer pay. And like I said, that's when you're really going to start seeing the effects of this when it comes to the economy. And the other thing we need to pay attention to that this is probably going to affect is the unemployment rate. Because like I said, the more businesses that cannot get loans, can't get the funding to move forward, will end up cutting jobs. And as people get cut, unemployment rate goes up. And that's the one thing I think most people are pointing to right now that are saying, oh, look, well, the economy is still in good shape because unemployment's still 3.5%, and we don't have to worry about another housing crisis because people can afford to pay their mortgages with the low unemployment numbers. People can still be out there spending in the economy because they have jobs. But what happens when unemployment starts creeping up? That's going to be the last nail in the coffin for this. And it's not like I want people to lose jobs or anything like that. This is just the reality of how this is going to play out as more banks fail and more banks tighten up lending. Inevitably, you're going to see the unemployment rate go up from this. That's why I see a lot of people say, oh, this is only going to affect, commercial real estate. People are still going to be getting loans for residential and everything will be good. Well, maybe the residential loans won't dry up like commercial loans and business loans might, but it's going to bleed into the rest of the economy when those type of loans do dry up, because everyone relies on this whether you realize it or not. If you work for a company, chances are you rely on commercial lending because the company you work for does. And the worst part is no one's going to want these office spaces. On average, a lot of these office spaces have declined by 25% in value because the amount of cheap debt that was on these office buildings can no longer be replaced with cheap debt because of the interest rate hikes, because all these places run off of some sort of floating rate debt where the rates can go up when the Fed hikes rates. And as you can see, the Fed raising interest rates is the source of all of these problems. But at the same time, the Fed keeping interest rates extremely low was also the source of all the problems that got us here. So as you can see, the Fed continually gets us in trouble. They leave rates too low for too long, bam, they get us in trouble. Now they start hiking rates, everyone's complaining it's too much too fast, bam, they get us in trouble. But I've said this before, I think they need to continue with the interest rate hikes and keep the rates high indefinitely, because that's where rates were at more historically and things were a lot more balanced in the past compared to where things are at now. So are we going to see a lot of problems from this? Absolutely. But if they stick with it and keep rates high, then eventually it can weed out a lot of these problems that have gotten us here today. And now that we just keep seeing more and more bank failures, it's even prompting, big shots like Elon Musk to come out and say that, we're looking at a severe recession, basically guaranteed. Musk just came out this week saying that we're already in a mild recession, guys. But now that you're starting to see this pile of dead banks, is what he said, then this is going to guarantee a severe recession in the near future, later this year. Elon Musk has been a proponent for the Fed to slow down on the interest rate hikes and even cut rates many times over this past year, because this has obviously affected him big time as well, as somebody who owns stock in big corporate companies like Tesla, for example. Tesla saw a $600 billion market drop in 2022, so that's not really good for someone like Elon Musk and his earnings and his net worth and all of this. So of course, people like that are going to want low interest rates indefinitely. But the thing is, that's not a sustainable way to operate things, because we can go back and look what was the federal funds rate throughout history. And when you look at this chart, you can see it was never as low as it was over the recent years and for this long. Never, 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 never. And we never had problems like we have now until they decided to keep the rates artificially low for too long. So that was the real mistake. And now everyone's getting the rude awakening, the wake-up call of how much it's going to hurt their pocketbook having the interest rates higher. But it is what it is. It's a necessary pain. Elon Musk is saying that, listen, I have more real-time data than maybe any other person in the world because of all of his connections to these large companies like Tesla, Starlink, and now Twitter, of course. He's saying that he gets more economic data on a regular daily basis than probably any other person in the world, which might be true. And that's why he thinks that the inflation is not as bad as the government is saying it is, and we don't need to be doing these massive interest rate hikes anymore. But, you know, it's easy for someone like Elon Musk to say that because he doesn't really live in the real world, guys. He might have more data than anybody else, but he's not the person that's going to be feeling the financial pain at the grocery store when eggs are triple the price and chips are double and, you know, milk costs 3 times as much and everything that people need to pay for. You think he's going to be worried about the insurance hike on his house or, you know, the property taxes going up? No, he's not affected by all of this stuff. But regular people are, and it's easy for the richest man in the world to come out and say that, you know, interest rates need to remain low and that, you know, the Fed's making a big mistake. But I completely disagree. I think they're doing the right thing by keeping the interest rates like this. I hope that they continue to do this throughout the rest of 2023 and even into 2024. And speaking of which, the markets now are pricing in an 89% chance that the Fed is going to raise rates by another 25 basis points on Wednesday this week at their next meeting. And I think that they will too, which is a good thing. That's what they committed to. That's what they need to stick to. And as if all of this isn't bad enough, guys, the next boot to drop, which is basically a guarantee at this point, is going to be the student loan debt. This is something that we talk about from time to time. And as of right now, by the end of June is when the Supreme Court's supposed to reach a decision on what's going to happen with the Biden student loan forgiveness program, where they'll forgive up to $20,000 of your debt. Because this was challenged, they've been sued, and that's why this hasn't happened yet. But the Biden administration says that this is legal and eventually it's going to work out because whatever they're proposing is perfectly within the law. And so these lawsuits are not going to work out. And this student loan forgiveness affects a ton of people, guys. Just in the first month alone, whenever they set up the website for people to apply for the student loan forgiveness, they had 26 million people apply, okay? And then they had 16 million people in addition to that that qualify for this automatically. So you're talking about 40 million people right off the bat that would be getting some sort of student loan forgiveness if all of this works out. So that's a huge amount of people, and imagine how that affects consumer spending and people's ability to buy homes and, you know, buy cars, buy everything. And the way that it's supposed to work out right now is the student loan payments are supposed to resume later this fall when all of this is done, whenever the Supreme Court decision has been reached and they figure out what's going to happen if people are actually going to get some of this debt relief or not. But either way, the payments are going to resume. It's just a matter of, are you going to get this $20,000 credit? Now, that might help somebody who's only $25,000 in debt if you can get most of it wiped out. But if you owe 300 grand in student loan payments, you know, 20 grand's barely going to put a dent in it. You got companies like SoFi Bank who they do a lot of student loan refinancing, and they filed a lawsuit to end this payment pause because, you know, these guys are hurting from this. Imagine we already have this banking crisis and these guys are not able to collect on probably some of the biggest debts on their book, which are the student loans. They're saying that this lawsuit is not likely to end the current payment pause, but it could prevent a further extension of the payment pause that's in place right now, which is what SoFi wants. They want people to start paying back these loans right now. But the way I see it, the reason I'm bringing this up is because I don't think it matters, guys. I don't think it matters if this passes or not, if they get this student debt relief. Like I said, I think it might help some people who have the lower amount of student debt, but it's not going to wipe away all of your student debt in some cases. Also, if you're already earning more than $125,000 a year, you're not eligible for any help whatsoever. So, you know, most people that got into massive amounts of debt are the ones that get the high paying jobs, so they're not going to get any help from this, okay? The payments are going to resume one way or another. It's not like all the debt's just going to be wiped away and everybody starts with a clean slate. You know, that's not going to happen. It's just a matter of, are you going to get that 20 grand or not? For most people, you know, if you owe 50 grand, you still owe 30, even if you get that 20 wiped away. So you're still going to have to resume those student loan payments when the time comes, and that's going to be it, guys. I mean, are people going to be able to afford this? How is this going to affect the overall spending in the economy? Which is why I'm saying that's likely to be the next boot to drop. If you guys enjoyed this video, make sure you click the bell notification down below. YouTube will alert you every time I post a new video. And if you don't want to wait, check out my next video on the screen right over here, and I'll see you in the next one.